good morning, and welcome to another live technical analysis. We're going to be looking at a few FX pairs. We might do a few stocks today, and we're going to be discussing the fundamentals and technical aspects. So, starting off with the euro against the dollar, as you can see, it is moving in a slightly sideways fashion. We can readjust our support and resistance lines. Let's just move everything and do it from scratch. So, we're on the 4 hour time frame. Now, based on what we've been seeing from Fed policymakers, it appears that they've adopted a more hawkish stance. And why is that? Well, the markets are anticipating six potential rate cuts by the Fed in next year, whereas the new dot plot indicated three potential rate cuts. As such, there seems to be a disparity between the market anticipation and what Fed officials have been saying, which is why you may be seeing a more intensified hawkish rhetoric emerging from Fed officials. For example, Chicago Fed President Goldsby, if I'm not mistaken, is slightly hawkish, and he is known to be more of a dove. Then you have Mester, you have Bostic. Bostic appeared slightly dovish yesterday, but still there appears to be some element of concern amongst Fed policymakers that the markets may be getting ahead of themselves at this point in time. So for the euro against the dollar, we can have S2 at 1.0825. We're taking this wick validated by this testing of resistance, which was broken and has now potentially become support. So this could be S2, 1.0825 for S2. Then for S3, we could take a swing low, or we could take this lower point of this wick. And let's just check that it's validated. Once again, same theory as it was before, simply inversed. Testing, this was resistance, broken above, turned support, same scenario here, tested for support. So potential support at 1.07235 and 1.0195, 1.0825, 1.07235, or 1.0725. So this could be S1, S2, and S3. Then for resistance, we take this recent high. So failed to break above, as you can see, was validated at a previous point in time as well, November 29th of November. So previous high tested, failed to break above. So potentially validating this as a resistance level. So we could have R1. Now note that the Bollinger Bands appear to be narrowing, implying low market volatility, and they appear to be moving in a sideways fashion as well. So we could maintain a sideways bias for the pair. So you have R1, 1.1005. Then for R2, we need to go back and look at these historical data. Now between S1 and S2, we have 87.5 pips of distance between the support levels. Therefore, it could be prudent to have the same distance between our resistance lines if we can. Now, for R2, the distance between R1 and R2 here is 56 pips, a bit too close for me, so I'd rather come back. So it's touching this wick, which formed the downwards moving trend line. Distance between R1 and R2, 85 pips approximately. And then we just need to check that it's actually potential resistance. Hasn't been validated recently, so I wouldn't classify this as a recent testing of resistance broken below turn support, etc. So it perhaps would be more prudent to have R2 at the 1.1120 figure, or it could be slightly higher. 113, 1140, probably better. And then for R3, 1.220, 1.221, or we could keep it at 1.220. Now, the distance between R1 and R2 is significant compared to our support levels. So we need to find, well, it'd be better if we could potentially bring resistance down 1.1120, and then we can keep R3 much better. You can see an upwards moving trend line beginning from this bullish candle, which has been broken. Narrowing of the Bollinger Bands. RSI is at 60, so it does imply a bullish market sentiment. Yet, if we add the volume indicator, so you can see there appears to be a decline in volume as well, seeming to validate our hypothesis. And as you can see, there was this previous high and is moving slightly lower. So less volume, narrowing of the Bollinger Bands, breaking below our upwards moving trend line, all seem to point towards a potential sideways motion between S1 and R1. Let's just make this slightly bigger. We need to fix our resistance labels as well. 1.1120. Then for R3, we have 1.1220. So have R1, R2, R3, S1, S2, and S3. Now, in terms of financial releases, we're noting nothing major from the Eurozone today. So perhaps we may be looking for comments by Fed officials or news stemming from the US. So for the British pound, we're going to be taking a bit more time analyzing the cable. So the UK's CPI rates for November were released earlier on today, and they tend to imply easing inflationary pressures in the UK economy. And when we say easing inflation pressures, it's more about the fact that lower CPI rates means that inflation might be easing, therefore less pressure on the Bank of England to remain perhaps at their current interest rate levels or even hiking. Therefore, lower CPI, weaker pound allows the dollar to gain, which is why for today it is in the red. It's essentially, well, almost eradicating or eliminating the positive gains made in yesterday's trading session. So, in terms of resistance and support levels, now we're keeping R1 at 1.2720. It's validated previously by the sideways moving channel, which it failed to break above. It did manage to, and note that this bearish candle, once it broke, it is now moving lower. So I would ignore this for now, as I think this is a more imminent resistance level. I'd keep R2 at 1.2870. This could be a temporary resistance level if it is broken back above. So we'll just place this as perhaps dark blue. For S1, we're keeping our support levels the same. 1.2595 for S1. It's currently aiming for it. Also, sideways moving channel. Since we're keeping R1, we're going to be keeping S1. Have S2, 1.2475. And then lastly, have S3, 1.230. So once again, the blue line could be a more temporary resistance line. I believe that R1 at 1.2720 is more of a significant resistance level, whereas The blue line would be a further indication if it is broken for a bullish outlook. For now, we're maintaining a bearish outlook given that the RSI has broken below 50, implying that the bears may be taking over the pair. It's broken below our support, our resistance turned support, now turned back to resistance line at R1, keeping R2 and keeping R3, aiming for S1. So for our bearish outlook to continue, it would have to break below S1 and potentially aim for S2. Final target for now being S3 at 1.230. For a sideways bias, failing to break below S1 and remaining confined between S1 and R1. And as we said before, for a bullish outlook, simply breaking above R1 and moving towards R2 would constitute a bullish outlook from my end. Now, dollar JPY, I'm guessing ever since the interest rate decision upon which the bank remained on hold, as was widely expected, yet with BOJ Governor Ueda's comments appearing to sound predominantly dovish, we've been seeing that the Japanese yen has been weakening against the US dollar for the past few trading sessions. Today might be a small correction before continuing on its ascent. In terms of support and resistance, we have resistance turn support at 142.5. So let's just not zoom out. Switch this from R1 to S1. From red, we can turn this to green. And then S1 becomes S2. Then old S2 becomes S3. And we are on the hunt for R3. So have S1, S2, and S3. Make this slightly larger. RSI is running along the figure 50, implying a neutral market sentiment. Yet, as we said before, there's an upwards moving trend line, continues to be validated. If this is not broken below, I would maintain a bullish outlook for the pair, perhaps aiming to test resistance again at 144.50. Whereas if the price action breaks below the upwards moving trend line, I would switch from a bullish outlook to a sideways bias based on the RSI breaking below our upwards moving trend line. And yes, the narrowing of the Bollinger Bands as well. So R2 becomes R1. Then R3 becomes R2. So I have R1, R2, S1, S2, S3. Bullish outlook as long as it continues to validate our upwards moving trend line. So for our bullish outlook to continue, we would like to see the price action, the pair, moving higher above R1 and aiming for R2. For a bearish outlook, simply breaking below S1 and aiming for S2. Sideways bias, breaking below our upwards moving trend line and remaining confined between S1 and R1. So R3 immediately on the upper band of the sideways moving channel, this old sideways moving channel. So 1.4835 R3. We shall be looking at, good evening, shall be looking at the S&P 500, NASDAQ 100, and the Dow Jones 30. If I'm not mistaken, the NASDAQ 100 has currently created new all-time highs. So I have R1, R2, and R3. So as we said, if it continues to validate our upwards moving trend line, maintain a bullish outlook. For the Aussie, it's broken above R1, aiming for R2. So this would be resistance turn support. And then, so R1, we could bring S1 slightly higher. 0.6625. Turn this to green. Now, from a technical standpoint, it's running along It's at 67, so it's near 70, or it could be said it's running along the figure of 70, so implying a bullish market sentiment. Now, if we draw a trend line from this bullish candle on the 13th of this month, continues to be validated, so moving upwards, we could maintain a bullish outlook, but based on what I'm seeing now, I'd expect it to potentially break our upwards moving trend line, validate S1 as an actual support level before moving higher. If it fails to move higher, then we could switch to sideways bias. For today, this could be a small market correction to the mid range of the Bollinger Bands before continuing on its ascent. So our oldest one becomes S2, then old S2 becomes S3, and we are now looking for resistance level at R3. Zoom out. Here we go. Let's see. Now, the reason as to why I'm placing R3 at this particular level, 0.6975 once we round it up, and I'm ignoring, let's say, this old high. Actually, perhaps the old high might be better. It's all a matter of perspective. One could argue that this level here is closer to R2. So based on the movements that we've been seeing, with the exception of this strong bullish upward fashion, onto the daily, you can see that it could break above, let's say, R1, aim R2. And in terms of the size of the candles, it could reach R3. But once again, it's mostly a matter of perspective. But based on what we saw, I'm actually going to take that old high, potentially a greater resistance level, 0.6920, 699.0, yes. And actually, we're bringing R2 slightly higher. Now, in this case, I wouldn't simply take the wick. And why? If you look back, where is it validated? It's in between the candles. Whereas, slightly lower, validated by this bullish, bearish, and two bearish candles. So once it broke below, it moved lower. It tried to wick above, but failed to, so implying that there is a resistance level at this point, and it's not too close to R1. So even if it does move higher, there's still enough room for it to, quote unquote, breathe. It's not too close. So for our bullish outlook to continue, it would have to break above R1. For a sideways bias, simply breaking below our upwards moving trend line, as I said before, could be a market correction. So it would have to fail to break below S1. So breaking below and going for S1, failing to break below and failing to break above R1 could constitute a valid sideways bias for the pair. And then for R2, 0.6910. R3, 0.6990. We will also be looking at oil and gold, considering the developments in the Red Sea, in terms of the coalition formed by the US to combat the missile attacks by the Houthi rebels on shipping vessels passing through the strait. That is an interesting development that we will be looking at how it has affected the markets in terms of crude oil, so WTI cash. I think we should skip ahead to gold. Now, in terms of support and resistance levels, We can keep S1, S2, and S3. R1 could be R1 will actually stay at 2048. So you could say that this is moving in a sideways fashion. From a technical point of view, it's between 50 and 60, but it appears to be taking a turn towards 50, further supporting sideways bias. We can draw our sideways moving channel between R1 and S1. Oh, S1 and R1. Narrowing of the Bollinger Bands between S1 and R1 further supports our hypothesis. So sideways bias, as long as it continues to validate S1 and R1 and failing to break below or above our support or resistance levels, respectively. For a bullish outlook, it would have to break simply above R1 and then aiming for R2. Next target would be the all-time high figure of 2,136. For a bearish outlook, simply breaking below S1 and then aiming for S2, or simply breaking below S1 would constitute as a bearish outlook, keeping our support and resistance levels the same. Moving on to oil. So over the past few days, as you can see, oil has been moving in an upwards fashion. On the weekly, it could end the week for a second week in a row in the greens. Now, this could be due to the fact that the current situation in the Red Sea. So the majority, well, a high amount of trade occurs between the Suez Canal, so connecting Asia and Europe. It cuts the time for shipping vessels drastically. So it's much easier to simply move through the Suez Canal. Now, the issue is, if you look at a map, Yemen is situated close to Djibouti, which is a prime location for naval bases of various nations, such as the US, China, France, etc., etc. The issue is that they've been firing missiles into shipping vessels crossing near the coastline, and they've tried to board. They've struck a few ones, which is causing concerns about the supply chain of oil, given that most of the oil, well, oil supplied to Europe could be supplied from the UAE, Qatar, Saudi Arabia, etc. There is a huge concern about how safe those shipping vessels are. So you're seeing BP, the shipping container company Maersk, as well as others, essentially saying that we're not going to be crossing through the strait as there is high tensions, there is high risk. Therefore, they could be moving through the, if I'm not mistaken, Horn of Africa, which is moving from South Africa and then coming from Gibraltar, and move and getting into the Mediterranean. Now that adds, I'm not exactly sure how much time, but you can tell that it's much longer than simply crossing through the Suez Canal. Therefore, concerns about supply chain issues may be supporting oil's price higher. Now, this bearish candle could have been upon the announcement that the US is creating a coalition to counter the current strikes in the region. Therefore, bearish sentiment, yet it appears that it is a great concern. And based on recent developments, I would not be surprised if oil continues moving higher. 73.95 for S1. Now for S2, we could place support at 70.60. So as long as this issue continues with the Houthi rebels in Yemen, we may see oil prices moving higher due to supply chain concerns. Whereas, should those tensions subside and BP, amongst other companies, announce that they're going to be resuming their normal trade routes, we may see easing of pressures on oil, which could potentially push oil prices lower. But for now, we have an upwards moving trend line. RSI near 70 at 66 right now, which implies a bullish market sentiment. So we would maintain a bullish outlook for the commodity. So we have 76.38. If you'd like to learn how to trade, we are offering an academy. If you look at IronFX Academy, it's free. You can register, and we have some very interesting material for beginners as well as for an intermediate level. So that may be nice. There are also quizzes that you could do in order to test your knowledge at the end of each subject. Continuing with the technical analysis, we have R1, R2, and then R3, 82.57. And then, so we're maintaining a bullish outlook. If it breaks above R1, it's validating our upwards moving trend line, and the RSI seems, well, it tends to imply a bullish outlook if it breaks above R1. For a sideways bias, staying between S1 and R1. For a bearish outlook, simply breaking below, well, not simply breaking below S1 and breaking below our upwards moving trend line could constitute a bearish outlook. Why? It's broken below S1, which is close to, and it's breaking below our upwards moving trend line. Then we may see a bearish outlook for oil prices, but that may be more from a fundamental point of view rather from a technical perspective. For now, maintaining a bullish outlook for crude oil. We're going to be looking at the Nasdaq 100 and the S&P 500. So for the Nasdaq, if we move on to the monthly chart, as you can see, it's broken and has created new all-time highs, which provides new questions for our support and resistance. Simply zoom out. So we can keep R1 17,000, R2 17,500, and then R3 18,000. Now you may be asking, since we don't have any historical data, how can we say that these are potential resistance levels? Well, in terms of psychology, we're placing them at intervals of $500 each. They're big figures, they're round numbers, therefore it is possible that we may see resistance at these levels. In terms of support, we have historical data, therefore we're maintaining S1, S2, and S3. It's broken below our upwards moving trend line, but given that it's broken all-time highs, it's not unexpected, so it could correct slightly lower, perhaps to S1 before continuing towards R1. Now, the Bollinger Bands appear to be tilted towards the upside, and further implying a bullish market sentiment. The RSI is still above 60 and is close to 70, therefore, there is still a bullish market sentiment, or appears to be, for the Nasdaq 100. For a bearish outlook, it would have to break below S1. For a bullish outlook, it would have to break above R1 and then move towards R2. Sideways bias remaining confined between S1 and R1. For the S&P 500, it's broken above our old resistance level at 4,630, aiming for 4,795. So this is a daily chart as well. It's aiming for all-time highs as well. So if we move on to the 4-hour chart, it's moving in an upwards fashion. We move on to the daily, it is also moving in an upwards fashion. Now let's remove for support and resistance, adjusting S1, 4,545 for S1, S2, 4,345, and then S3, 4,115. For R1, 4,795, 4,958, and then I'm guessing that's it. Yes, so we could extrapolate the distance between support S1 and S2 and then reflect it between R2, or we could simply take S2 and S3. So 2, 3, 5, 6, 8. So we could say 5,190 could be our R3. Now these are estimations. We don't have any historical data. Such it remains to be seen. But it appears to be continuing moving in an upwards fashion, having formed another upwards moving trend line. It had broken below, moved sideways, accumulated perhaps buy orders, and moved higher. So we could maintain a bullish outlook given that the RSI is above 70. But it's currently at 79. So it could be said that it is slightly above 70. So it could be overbought, and as such could be due a market correction lower. Therefore, for a bearish outlook, simply breaking below our upwards moving trend line would not constitute a switch towards a bearish outlook. It would have to break below S1. For a sideways bias, it could simply be breaking below our upwards moving trend line and remaining confined between S1 and R1. For a bullish outlook, it would have to break above R1 and R2, potential target being R3 at 5,190. But for now, it appears to be a bullish market sentiment. If it does correct lower before continuing, I would not be surprised. Dow Jones 30. Move on to the monthly chart. So we had done the same for the Dow Jones 30 as well, where we extrapolated the distance. And as you can see, it appears to have been roughly accurate, I'd say. So R3, 3,000, 37,320. So this could be our newest one. S2, 36,770. 36,255 for S3, and we're going to be extrapolating the distance between our support levels and then reflecting them higher to find potential resistance levels for the Dow Jones 30. Just remove this out of the way. Distance between S1 and S2 is 524, so reflected upwards 524. 37,835. 1,385 could be R1. It's a mistake. $37,830. 830. And then distance between, so 526 again. 38,350. That could be R2. 38,860. Could potentially be R3. So we've now placed potential resistance levels. Now we should note that we do not have historical data, and as such, these are simply assumptions. But for now, we could maintain a bullish outlook for the index as well. Upwards moving trend line hasn't been broken yet. Continues moving higher. For a bullish outlook to continue, we would like to break it. Would like the index to break above R1, 37,830. Then aiming for R2, then potentially R3, but simply breaking above R1 constitute a bullish outlook. For a bearish outlook, simply breaking below S1 and moving towards S2. Now let's also look at Apple. We're going to be looking at Apple because they have announced that they will be halting the sales of their newer smartwatches. Why? It appears that a court ruling has found that they might be in violation of Massimo's proprietary technology in terms of one of the features that they're offering. And as such, they may be, I think they have said that they are preemptively stopping sales in the US, not in Europe or in Asia, simply the US. I'm assuming that they might probably file an appeal, so continuation of the court. But if you're stopping the sale of one of your products during the holiday season, then you might be missing out on revenue. If it continues, it could impact the company's revenue from a more macro perspective, and as such, it could weigh on the company's stock price. For now, though, from a technical perspective, it appears to be bullish based on the RSI being at 70, so bullish market sentiment, upwards moving trend line, yet that could change. But nonetheless, let's place R2 and R3. Now, this was a stock split, but looking at historical data, we could have R2 209.80, and then we could place R3 previous high 216.90, and there we go. We have R1, R2, and R3, S1, S2, and S3. From a technical view, appears to be moving in upwards fashion. From a fundamental point of view, though, we may see a slight weakening in the company's stock price. And I think that does it for today. Thank you for watching, and until next time.
Everyone, my name is Emily and today we're going to talk about inflation. In a market economy, prices for goods and services can always change. Some prices rise while some other prices fall. Inflation occurs when there is a general increase in the prices of goods and services. It means you can buy less for €1 today than you could yesterday. In other words, inflation decreases the value of the currency over time. When measuring inflation, all goods and services that households consume are taken into account, including everyday items such as food and petrol, durable goods such as clothing, PCs, and washing machines, and services such as hairdressing, insurance, and rented housing. All these goods and services that households consume during the year are represented by a basket of items. Every item in this basket has a price, which can change over time. The annual rate of inflation is the price of the total basket in a particular month compared with its price in the same month 1 year earlier. In a healthy economy, annual inflation is usually in the range of 2 percentage points, which is what economists consider a signal of pricing stability. And there can be positive effects of inflation when it's within range. For instance, it can increase spending and thus stimulate demand and productivity when the economy is slowing down and needs a boost. On the contrary, when inflation begins to exceed wage growth, it can be a warning sign of a struggling economy as consumers' purchasing power will decline. Inflation impacts consumers most directly, but businesses can also experience it. As mentioned, when inflation rises too much and it is higher than wage growth, then households or consumers lose purchasing power as the prices of items they buy, such as food and petrol, increase. Companies also can lose purchasing power and see their margins decline when prices increase for raw materials used in production, such as coal and crude oil, flour, and steel. To respond to the rise in prices, companies tend to raise the prices of their products or services to offset inflation. This means that the products that consumers will buy will become more expensive. Statistical agencies measure inflation by first establishing the current value of a basket of various goods and services consumed by households, referred to as a price index. When calculating the rate of inflation over time, agencies compare the value of the index over one period to another, such as month to month, which gives a monthly rate of inflation, or year to year, which gives an annual rate of inflation. For example, in the United States, the Bureau of Labor Statistics publishes its Consumer Price Index, which measures the cost of items that consumers buy out of pocket. The CPI is broken down by regions and is reported for the country as a whole. Another measure of the prices that people living in the United States or those buying on their behalf pay for goods and services is the Personal Consumption Expenditures Price Index, which captures inflation across a wide range of consumer expenses and reflects changes in consumer behavior. Thank you so much for watching us.
Okay, so welcome to this week's trade management webinar. So today we're going to be talking about trailing stop loss. So as per usual, before we get started, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie, and I am your host for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. Okay, we will firstly talk about the anatomy of a trade, followed by some recap of last week and the previous week's information, some trade management techniques, just a really brief recap on those, and then we'll jump straight into this week's trailing stop loss techniques, and we'll look at some examples of them as well. And if we have time at the end, we'll also go through a couple of live analysis charts. So feel free to pop into the chat if you have any questions or any requests for any charts that you guys would like to see. Okay. Now let's go ahead and get started. So the anatomy of a trade. Firstly, of course, we have our entry, stop loss, and take profit. And then followed by our break even, partial profit, trading stop, and idea invalidation. So let's look at, I think if you were here in our previous webinars part of this series, you would know that you would know what exactly these break even, partial profit, trading stop means, or idea invalidation rather. But not to worry, if you weren't here, I'll just do a brief recap right now. Okay. Okay, so firstly, let's look at our take profit stop loss placement recap. So we typically would recommend you to place your stop loss beyond a major resistance area and your take profit before a major resistance area. So if you're wondering about this, let me just pull up the Forex Army website so that you guys can see. So if you're new to technical analysis, right? If you're new to technical analysis, you can actually just go to this website. Let me just pop it into the chat in a bit. But go to this website and then you guys can look at all the different Fibonacci techniques. Yeah, here. So we typically will recommend you to place your take profit before a major confluence area and after a major confluence area for your stop loss. So in this case, we are looking at a buy entry. In this example that I have here on my slides, obviously we are talking about a sell entry since our take profit is below instead of above. Okay, so I just wanted to pull this out to show you guys the variations if you're looking at a buy entry versus if you're looking at a sell entry. So maybe I'll just type out the website in the chat. It's theforexarmy.com. Okay. Yeah, you can go ahead and explore that website on your own. And okay, so we went through this in our very first part of the trade management series. Okay, next we're gonna look at break even. So break even is basically a level in which you are in profit and recognize that there is a risk of reversal. So it's basically you saying that if you are right, then your price should go all the way to your target. But if it goes back to your entry, then you are wrong and you should get out. So over here, we have an entry at the breakout. Over here. Okay, so we have two multiple swing high resistances, and we're going in for our entry at this breakout of this resistance level. Okay, so we're hoping for price to push past our take profit, which is over here, the green area here. So we take note of our original stop loss, which is below here at this swing low. Okay, and at point 3, which is over here, that's where our break even was triggered. So it's where our break even is triggered because your break even level, which is typically in between your entry and your take profit level. So we've chosen this area since it's a swing high resistance level. Okay, so we are going in for a buy. We're expecting price to rise from our entry all the way to this level here. Okay, and we see that price has reversed off of our break even, and that's where our break even is triggered. So we are going in and moving our original stop loss over to our entry instead. Okay, so you see me keep constantly looking to the side. It's because my monitor is over here. Okay, but yeah, so our break even is triggered. We are moving our stop loss over to this entry level so that if price continues in our favor, which you see it originally did, okay, it's continued, broke out of the break even resistance level and hit it towards our take profit, then of course that's good news. But if it reverses, you can get out at break even and your position is protected. Okay. Okay. So in our second part of the series, we talked about break even and partial profit. So we just talked about break even. Now let's look at partial profit. So partial profit basically means as the name implies, you get a partial profit of your trade because the trade perhaps didn't meet your expectations, didn't hit your take profit, but it hit halfway or maybe 3/4 of your trade. So in this example, we are going in for a buy entry at our first support level. Okay, so our first support level is at the 0.68736 level, and our stop loss is placed slightly below that at a overlap support level. As you can see, there is a swing low here and a swing high here. Okay, so we place our stop loss slightly below that, and our take profit is over here at 0.70512, and it's at this swing high resistance. Okay, we have a couple of Fibonacci levels to support our levels as well. So firstly, we have a 61.8% Fibonacci projection. Okay, that lines up with our take profit. But excuse me. But then we also notice that we also have a 78.6% Fibonacci projection and a 38.2% Fibonacci retracement that lines up nicely with our partial profit. So if you're thinking where exactly should you place a partial profit, firstly, you can pick any levels that's in between your first support and take profit. You can look for levels that have a swing low or swing high. That's basically how you identify levels. Okay, that's the first step. Next, you could maybe look at supporting that level with Fibonacci levels like we have done over here. So you can see our partial profits at the swing low level. Okay, but it's also supported with two Fibonacci levels, making it a pretty significant Fibonacci confluence area. Okay, so we're expecting price to rise to our take profit, of course, but there is a strong resistance at this Fibonacci confluence area, so that's why we're placing our partial profit there, just in case price isn't strong enough to push past that area. So you can see price testing this area now. Okay, yeah, so you can see price testing that area, and it's reacting off of it, but we're not sure if it's actually gonna surpass that area or break out of that area. Okay, and you can see that it actually reversed off and hit it back down. So we did get out of our trade with a slight partial profit, even though it didn't hit our take profit. Okay. Next, we have idea invalidation. So we went through this last week as the third part of our series. So idea invalidation is usually placed before your stop loss. So it's basically the opposite of your break-even levels. So for break-even, we would move our stop loss to our entry, but in this case, we are moving our take profit to our entry instead. Okay, if I sound a little bit sick, it's because I'm just recovering, so bear with me in that. But okay, so It's the level at which you basically admit that you are wrong and you want to get out of the trade ASAP. So when this level is reached, your take profits move to your entry, giving you a small chance to get out at break even. So in this example, we're looking at your entry at this double swing high level. Okay, we see price dropping, reversing off of that resistance and heading downwards to our take profit. You can see how we've placed our take profit before a major confluence area or major resistance area. As you can see here, we have 3 swing lows. So we're placing our take profit slightly above that. Here we see price reverse and it's heading up towards our stop loss. Okay, so the point in which your idea invalidation is triggered is at this point. Your idea invalidation, as we mentioned earlier, is placed in between your stop loss and your entry level. So we've chosen the swing high level here. So once price hits that level, even if it does reverse back down towards your favor, we're moving our take profit upwards to our entry so that we get out of the trade at break even before price rises even further and stops us out. Okay. Okay. Let's look at some examples now. So in this example, we have a swing low here, and we've placed our buy entry at that swing low, and we have a Fibonacci 50% Fibonacci retracement that supports our take profit level. Our take profit level, as you can see here, is an overlap level because we have a swing low and a swing high that line up nicely at that level. Okay. So you can see our entry, so our entry is at that level. And now we are going in with our Fibonacci extensions as well as expansions. So if you're not familiar with what those are, we basically go through those in our Fibonacci series. But you can also check them out on the forexarmy.com, which is the website that I have included in our chat. Okay, but basically you can see how our 127.2 and the minus 27% line up nicely. So I'll show you guys in a little bit during our live analysis session how you can obtain these levels. Okay. Okay, but yeah, for now you just look at these levels, see how they're aligning. That's basically giving us a Fibonacci confluence area. Okay, so yeah, so you can see entry and our price. So we're placing our stop loss below our Fibonacci confluence area here. Just like we mentioned, we always want to place our stop loss beyond any confluence areas. Okay. And now our idea invalidation, we are placing exactly at that level. Okay, so if price breaks out of our entry, hits downwards towards our stop loss, okay, at least when it hits our idea invalidation, we will get out at break even. You can see that's exactly what happened over here. Okay. And then once it hits our idea invalidation, we then move our take profit down towards our entry. Okay, so that we get out at break even. Okay, that's basically it. Yeah, so if we didn't do that, price would have stopped us out because price actually continued to drop. Okay, so now let's look at this week's topic, which is our trailing stop loss. Okay, so trailing stop loss is basically a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. The idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe. as the stop loss follows the market price as it moves in favor of the trade. So this example that I have over here is in terms of stock prices. But it's just to give you an idea of how it works. So let's say you buy a stock at $100 and you set a trading stop loss at $10. As the stock price rises to $110, the stop loss will follow, now at $100, because 110 minus $10. So if the price, if excuse me, if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. The trading stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. Okay, so this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that the trading stop loss is not a guarantee that you will exit a trade at the desired price. Market conditions such as gaps or rapid price movements can trigger stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. So if you combine this with all of the methods that we've mentioned above, and throughout the past 3 webinars, you're pretty much set for your trade management strategy. Okay, so here are the different methods of a trading stop loss. You can see we have moving averages, chandelier, parabolic SAR, ATR, so on and so forth. Okay, even support and resistance levels and a combination of these methods. So let's go through our first example, which is the moving average. So in this example, we are going in for a sell entry at this level here, with the 1.57891 level. Okay, so once price breaks out of that area, then we're going in for a sell. And the reason for that is because you can see that we have an ascending trend line. Okay, so what makes an ascending trend line valid is if there are 3 touches on it. You can see very clearly over here we have 1, 2, and 3. Okay, and on our third point, you can see price breaking out of that ascending trend line and also breaking below that overlap support level. Okay, so it's breaking below it and we're going in for a sell. So you can see here, price has continued to drop. Okay, and price is moving below our moving average, which is typically a sign that a bearish signal. Okay, if price moves below your moving average, it's typically a bearish signal. And once you see price cross over your indicator, that's a sign that that the trend might change, and that's when your trailing stop loss is triggered. Excuse me. Okay, so that got us out of the trade before price started to move upwards. Okay, pretty self-explanatory. Now let's look at a trend line breakout. So we have one trend line here, but we have another one over here, as you can see. Okay, and so price moving in this descending trend line, and we see price breaking out of our descending trend line. So that's typically a sign that trend is going to change as well, and your trend line trading stop loss is triggered, so you get out of your trade. Yeah, of your selling trade. Okay, if we look at our parabolic SAR, pretty similar in logic, I guess. In this case, we see price moving below the indicator, so it's also a bearish signal. And then we start to see price giving us this, price moving above our parabolic saw. So it's giving us a bullish signal. And then we see price crossing over our indicator. So then our parabolic saw trading stop loss is triggered. Okay. Now, if we look at chandelier and ATR trailing stop loss, okay, we have our sell entry at that same spot, okay, and price is moving below these indicators, so it's a bearish signal. And once price crosses over these indicators, our ATR stop is triggered, chandelier stop is triggered, and you get out of the trade. Okay. Pretty self-explanatory there. Yeah, so if we combine different indicators, obviously your trailing stop loss will be more effective. So here we see our moving average indicator being used. So price is breaking below our sell entry as well as our moving average. So it's giving us a bearish signal. So we're going in for a buy, or rather for a sell towards our take profit. And you can see we've placed our fixed stop loss over here, right, at this swing high here. Okay, but we're going in for a sell towards our take profit, and once price crosses over the moving average indicator, that's a sign for us to get out of the trade, because it's typically a sign that the trend is changing. Okay, similarly for this example as well. Okay, using breakouts as trading stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So stop loss will help you to manage risk and protect your capital, and a trailing stop loss can help you to protect your profit. So in this example, we're using chandelier and ATR. Okay, so we see, and we're also using support and resistance here. Okay, so you can see that we're going in for maybe a buy entry here. Okay, so we're seeing price moving above our indicators, which is a bullish signal. Once price kind of starts to cross over each other, that's a sign that the trend is going to change. Similarly, over here, we are using support and resistance to highlight the different levels that we want to pay attention to. And then we're seeing price moving above the indicators. So once again, a bullish signal. And once price crosses below the in this case, it's a resistance. Okay, so once price crosses over this resistance level and it also crosses over our indicator, that's a sign that the trend is about to change. Similarly, for this example, we are using a moving average indicator instead. Okay, but it's the same concept. You see price moving above the indicator, it's a bullish signal. If it's moving below, you can see it's a bearish signal. And if it crosses over, it's typically a sign that the trend is about to change. Okay, that's about it for my slides. We still have a bit of time left, so we can take a look at some charts. Let me just pull up my charts really quickly. Okay, let's maybe go ahead and look at gold first. Okay, okay, so starting off, we're gonna look at our weekly time frame. Okay, so on our weekly time frame, okay, let me just make sure that okay, okay. So on our weekly time frame, okay, this is what our charts look like. It's pretty bearish, okay. On our daily time frame, also pretty bearish. Okay, now let's look at our 4-hour time frame. Okay, first on our daily time frame, let's add some support and resistance levels. So firstly, this is our first resistance. Okay, and then our first support. And maybe a second support here. Okay, now let's look at our 4-hour time frame. Okay, I think this would be my first support instead now, because it's closer to where price is at. And then this would be my second support. Okay, now let's go in with some Fibonacci levels. Okay, I'm first gonna go in with a Fibonacci projection. So I have my 61.8% that lines up nicely with my first resistance. Okay, and next let's go in with a retracement. So my 38.2 lines up nicely with my 61.8. Okay, and over here I can see this level, 50% lines up with the 23.6. So I'm just gonna keep those two as well. Okay, so I'm actually gonna add a level here because this is an intermediate level. Okay, because I have Fibonacci confluence area here, and I also have some swing highs over here. Okay, now let's go in with some indicators. Okay, price is moving above our Ichimoku cloud, so it doesn't support our bearish analysis, but on our MACD it is bearish. So I'll just get rid of our Ichimoku. Now let's look at RSI. Okay, RSI isn't telling us much. Let's look at stochastic. Okay, on our stochastic, we are seeing a bearish divergence. Okay, so between these two lines, you can see price is pretty price has stayed the same level at our first support, but on our stochastic, okay, it gives us a price is making a lower low. Okay, so that's a bearish divergence. Now let's look at moving averages. Let's look at MA, simple, and exponential. Okay, price is moving below both of these indicators, though it does look like price is breaking out of our EMA or SMA. So I might remove that. Okay, because it doesn't support our analysis. Okay, that's about it for our dollar franc. Okay, so we will definitely see price testing this level a bit. Okay, we'll see price testing this level because of the confluence area as well as the overlap levels. But yep, I think ultimately it will continue in the downward because of the downward pressure. Okay. Okay. I think we still have a bit of time left, so let's look at gold. Okay. Same thing, we're gonna look at the higher time frames first. Yep, I think this video, this because this webinar is being recorded, so I think they will upload this onto YouTube. So I think you will be able to get it there. But if not, I think you can email the IronFX team and they'll be happy to help you out. But it is being recorded, so you should be on YouTube. Okay, so on our weekly time frames, we can see it's pretty bullish, right? On our daily time frame, okay, on our daily time frame, we can't really tell because it's kind of trending. Okay, now let's just go in with our support and resistance levels first. Okay, and for my first support, maybe here. Okay, and okay, now on our 4-hour time frame, think most of these levels still hold up on our 4-hour time frame. But I think instead, I want to place my first support here instead. Okay. Second resistance maybe here. Okay, now let's go in with our Fibonacci levels again. So I can see my 78.6 lines up nicely. I want to see if my 61.8 lines up with any other important Fibonacci levels. Okay, so I will test that in a bit. Now let's look at projection. So 61.8. Okay, all of these levels price has already broken out of, so that's no longer valid. Hmm. So I think that's all the levels that we have. Okay, my 61.8 lines up nicely, and my 50% as well. Okay. That's all the levels that we have here. I'm actually going to remove the 61.8 because can't find any other levels to match up with that, as well as our 50%. Okay, now let's go in with our indicators. I'm going to use MACD, Ichimoku, and RSI again, because at one glance you can see exactly what the signals are. So on our Ichimoku, you can see that price is moving below the Ichimoku cloud, so it's giving us a bearish signal. On our MACD, you can see it is giving us a bit of a bullish signal, so I'm just going to remove that. Okay, on our RSI, okay, price is actually giving us a bullish signal here. Okay, because it is breaking out of the descending trend over here. So I'm gonna move that. Let's see. Ooh. Let's look at moving averages. Okay, price is moving below both of the moving averages, so it supports our bearish signals. And let's look at Bollinger Bands. Okay, Bollinger Bands aren't really telling us much, so I remove that. Okay, let's look at stochastic. Okay, stochastic gives us a descending trend line, so that also supports our bearish signal. Okay, so because there are so many indicators, it's important to just pick a couple that you are comfortable using and that you know how to use properly. Yep, and then just flip through those few after you're done doing your Fibonacci as well as graphical analysis. And then, yeah, just go from there. So if majority of your chosen indicators give you an opposite signal of what you are going for, then maybe you can go back and check your analysis again. But normally, if you've done it properly, most should support your own analysis. Maybe not all, like you've seen over here, RSI and MACD didn't support this analysis, but you can see that my stochastic, my moving averages, as well as my Ichimoku all support my analysis. So Yeah. Let me know if you guys have any other questions. Okay, if there are no other questions, that's it from me for today. Thank you guys so much for joining me. I am so sorry for my voice. Um, I'm just recovering from the flu, but I will be better next week, hopefully. And I'll see you guys then. Have a great rest of your week, everyone. Bye. No worries. I'm sure I'll be better by next week. Thank you. Bye, guys.